Sometimes in life we're faced with a tough question, but what happens next might surprise you. The S&P 500 is brushing up against one of the most important trend lines that we've seen in some time, and what happens here is going to be incredibly important to the next few months. Bill Ackman's also claiming treasury yields are going higher, and at the same time, we've seen a bounce on the S&P 500. So with semiconductors rallying, treasuries dumping into levels that we haven't seen for over a decade, what happens next? Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If you like anything to do with macro lead indicators and of course the hottest charts, remember to subscribe and smash that bell icon. Let's get into it with talking about what did well over the recent sessions. We've had semiconductors recover, including AMD, that was a heavy sell, and of course utilities continuing to find sells across the board with gold. But it was much more than that was really being felt by the markets over the last couple of weeks, and more importantly over the last 24 hours. And we've got a new read, and that is dollars and yield are overbought. Basically, there's a feedback loop. When everyone's chasing good yield, they first convert into US dollars, rising up the price of that. That then converts into treasury yields, and it's kind of like a self-fulfilling prophecy. At the same time, though, we're getting this volatility spike that tends to come through over the next 2 weeks. So don't be surprised if we get a lot of volatility that usually comes off a reading such as this. At the same time, on Twitter or X, we shared this bearish sentiment is everywhere chart. Over the last 2 months, bearish sentiment has literally doubled, and it's now just reached the same period that we saw during January into kind of March of 2022. We all know what happened there. We did sell off. We obviously found some big sells, and then we found some relief rallies. So could we be entering into a relief rally right now? Well, we'll look at that a little bit later on in the charts because there are some key levels that we need to be watching. But bullish percent index says no at this stage, or at least if this relief does come through, it could be a false rally. We'll continue to share this market indicator because we know that it can often tell us when lows are in, and more importantly, when the recovery is going to be more significant and possibly activate swing trades for people out there. So for bears, are you excited? Well, this is when usually markets start to turn towards the positive side. We've seen a negative August, we've seen a negative September now, but will we see a positive October, November, and December? Historically, you would say yes. Generally, when we have such bad second halves to September, we do tend to have an okay run at the rest of the year. In fact, you can see here when we run through those data stats, we tend to have an 8 and 0 run. That's 8 positive, 0 negative in similar situations. 100% of the time, actually, in significant data terms, we do end up seeing a bullish market. But will it be the same this year? Well, of course, you could argue both ways. Here are some more stats. 92.3% of the time we end up bullish over the Q4. So we're going to have to be very, very careful. But as you can see, October is not necessarily always positive. In fact, there was a period where we saw a 3.2% down over the month. And also in pre-election years, it tends to go something like this. Kind of a rally into the beginning, a sell-off in the middle, and then from the middle onwards, we tend to see positivity. So watch the data, watch the stats, but more importantly, watch the price action on the charts. In terms of large trades, there were some significant trades coming through the NASDAQ over the last 24 hours with big buys of over 1 million in terms of block trades. And we saw that as being 50 times the average of both of these particular trades. So 50 times the average, the biggest since September 15th. Obviously, somebody is probably trying to buy. At the same time, we saw a little bit of relief coming through the SPY, and as we reported in our last video, we saw some buying coming through on the Tuesday into the Wednesday. So someone's probably trying to buy, pick up this market, and there are a few reasons why that we'll go through later on in today's video. Let's bring up options, unusual options activity. It's pretty clear that there's some large trades going on in the gold markets, obviously leading to a bit of selling, but I think this one's interesting. NEE. Just absolutely getting obliterated with puts recently, down 4.8%, and that's continuing to sell and sell and sell. Some stocks that are looking interesting, we've got things like Nike down here that's going into a period of big kind of usual strength, and that's at 3.75 times the average 90-day volume trade with 124,000 puts. So still people putting the negativity on Nike. But is that all coming to the end? We'll actually look at that in our Monday live stream show, which we should be able to do next week. Let's talk about everything to do with calls and puts. 51% calls, 49% puts. and really just a 50-50 market with 36 million compared to the normal 39 million average. In terms of rotation, what was going on there? Well, we all look at rotation. We ask ourselves a question of what is this market actually telling us? Well, it's telling us that there is inflation problems under the hood. Why do we know that? The number one best one for the last 24 hours was actually metals, followed by semiconductors. If we take a look at the last 5 days, though, metals and energy make up number one and number two. So although semiconductors have improved, it was all about the inflation-based trades that have been doing really well, energy and metals. What was really doing poorly, though, was gold and utilities. Now, gold hates, and we've talked about this before, gold absolutely hates increased yields. So as we're going through these US 20, 10, and 2-year yields increasing, and in fact, all yields across the board increasing, don't usually expect utilities and gold to do too well during those times. And of course, the market's been selling them off accordingly. Now, we've talked about gold a few times, but we'll go through that very, very soon. So what about the NASDAQ 100? Are those stocks selling off aggressively? Well, the answer is not really. I mean, we've got here that 61% of the NASDAQ 100 stocks are still above their 200-day moving average. Where things change a lot is when we go to a code such as this, which is, of course, the percentage of stocks above their 20-day moving average. Only 27.59% of stocks are. This is often a bottoming level for markets. And we also see on the 50-day here, moving average, that we're sitting right where we were in March. So does it make sense that the market could be rallying here? Well, let's just quickly go back over to that SPY trend line. This is the trend line that everyone's going to be talking about. There's actually a lot to break down here in terms of charts, but it's noticed that we hit this in October, we hit this in March, so the last big sell-off, and we're hitting it again now. So these are the three major inflection points for markets, and that's why it's such an important level. If this level gets broken down, where will we go next? Well, it's highly likely we're moving towards that 4150, even potentially even lower, which will take us into kind of like a 4050 zone. So something in here seems likely if we are able to make a new low, and we'll want to be setting an alert for that as we move forward. Let's take a look at the 2-hour chart now just to get a bit of an idea on the S&P 500 before we go into the lead indicators. And I wanted to just kind of point out here, and we'll come back to the S&P later, that we saw a higher high. So we actually saw the market kind of recover, but you can see that's on the 20 moving average now on the 2-hour. We've got all sorts of things sitting right around this zone. So certainly an important point for these markets. The VIX, did it go above 20? The answer is no. So usually we like to see a VIX above 20 to kind of point towards a real proper capitulation sell-off. So at the moment, while there could be a recovery, unless bullish percent index and a few other things come with us, there's a good chance that that recovery will be met by further selling a little bit later down the line. So we'll have to be, really on the lookout, I'd say, for that. Notice back here in March, we got a VIX over 25. That's a pretty normal read when you're talking about proper sell-offs, getting a VIX above 25. US 20-year, 4.9%, still high, but has come down quite a lot. US 2-year still holding above 5, but again, kind of coming back off the previous. Core PCE price index will be coming out in less than 24 hours, so that might be quite important to see what happens with yields. But they're trying to hover. If we continue to go into the fear of the unknown, expect bears to take full control. So some important data points coming up as well for the market as we move forward. Let's move over to high yield bonds. What's going on in high yield circus? Well, they've recovered. Basically, the last 24 hours, we saw quite a large recovery here in high yield bonds. And you can see if that's the way the week closes or the weekly closes, that's going to be kind of positive towards the bullish people in the markets at this stage. What about home builders? Well, home builders also posted a recovery. We were talking about this potentially being like maybe an island reversal where it was going to create structure and then gap up one day. Unfortunately, that's not what quite happened, but it has been sitting, and this is the first positive sign for markets. So through this entire sell-off, there's really been nothing good. This is the first time we've started to see some recoveries, and it's not just in home builders. We're also seeing it in a few others. Treasuries as well. This is in a decade low point. This is basically back to 2009, 2010, 2011. Is this the point where we finally see buyers? Look at this wick. So the weekly's putting in a wick. You can see here the daily big bullish kind of candle coming through. It's quite oversold to the 20 moving average. And I could see buyers finding a little bit of excitement here in treasuries. They've been in free fall and they're starting to look incredibly attractive, especially to investors. Money's just piling in, but it's been a buy the dip kind of philosophy for a long time. Most people have been wrong. At this point, with what it's done, the way it's practicing, this is definitely where I'd expect structure to start to form on treasuries. Let's move over to the US dollar. The US dollar has been strong, very strong. Now it's sold off. Again, this will move, at this stage just in the trend up because, of course, this is not big enough for us to say, oh, wow, the trend's ended. Do watch the 20 moving average, though. We've hit this multiple times now. 1, 2, 3, multiple times. If it comes back to the 20 moving average, which is this red line, and then closes underneath it, there's a good chance that that's going to be a weakening formation for the US dollar, and it could spell kind of like that beginning of a new bull run for markets as well. So US dollar will be key over the next month. Gold still selling at this stage. You can see it's been very aggressively sold off, and it doesn't tend to really pick back up until sometime late October into November. So generally speaking, I stay kind of a little bit away from gold at this time of year. We did talk about it, and I said that gold spot tends to have a pretty bad run on it. It just so happens that at the same time we saw an increase in inflation, and of course we saw an increase in bond yields. So when that happened, gold didn't do too well. 2-hour chart, if you are thinking of getting positive on it, you're going to want it past 1880. So mark something like that high up here. And then once it gets past a supply like that, if you are looking at it, could have a little bit of temporary strength at this stage. So gold, still negative for now. Let's move over to US oil. Now, everyone's getting excited about US oil again, and probably rightfully so. US oil's pulling back, and it's coming back to a pretty interesting zone. Somewhere around this $90.50 a barrel. We've got a little order block that was basically built before it broke through. Then it went to a rally to a new high, which we spoke about in the last video, and I was pretty comfortable we would hit a new high, and the reasons are quite simple. It was a very strong replicable setup. But at the same time, could we go to $96? It's possible. We're still in an upward trend. Again, 20-day moving average, something to be watching. But I would say something around $90.50 to $90.80 could be a good technical level for people to dial in on. Of course, you make your own decisions. This is just a concept of what we're looking at on the price action. Let's move over to the biggest stocks in the world now before we go to indices. AAPL to start off with. Everyone's talking about this. On one of the planes through the US, I was listening to everyone going on about where Apple was closing. A lot of focus on this chart. In fact, they had a stat, and I think it was that something like 70% of people believe that Apple would not go below 165. So the reason partially why that is this 200-day moving average. And of course, just in general, people don't think it's got more sell-off in it. Long leg dojis, we know are indecision or equilibrium. So for AAPL, do I think the worst is over? I don't know that yet. I know it's getting shorted by a lot of funds. We do have a high and a low. And if we do end up taking the high, I would say we move towards, a higher point, which will probably be around something like 176. If the low is taken, I wouldn't be surprised at all for us to break below the daily 200 and then to possibly even continue to move off. That would be where we'd expect that capitulation event to occur. Semiconductors have done pretty nicely in the last 24 hours. Basically, we'd be looking now for pullbacks to be met by bull demand. This is a temporary turn. So it's showing you that maybe the worst of the initial sell-off is over for now, and we're going back to what you would call mean reversion. Now, mean reversion is generally considered back to the 20 on any time frame. In this case, usually we use weeklies, but we can see here that a 50 is sitting about 148, and a 20 is sitting around here at a price of, I think, probably about 147. So I'd say like 147 is quite feasible for semis. I'd look for a pull into a long in terms of from a technical perspective. And if we manage to get through 148, it could be that actually the worst is beyond us in terms of selling and that we're back in a bit of recovery into the rest of the year. Remember, the data does point towards that being a very likely kind of thing. For Tesla traders, you guys are just looking for 250 to be broken back above. That was originally our short target. Now we're starting to see the signs of, again, recovery in this market. It may be short-lived, but above 250, drops should be basically met by bull demand. And although you might be feeling bearish on markets, they are quite overly extended. And we'll go through some indices now just to prove that. German 40 first, a tweezer bottom style. Basically, this is two lows that are very similar to each other. Both have been met by bull demand, and it's kind of pointing towards, again, a bit of a recovery. Now, if we take the percentage here and we work this out, that would be about 1.5% recovery for the German market, and it would push into so many moving averages. Take a look at this here. We've got the daily 20. We've got the daily 200 sitting right on top of each other and a level of supply previously. So there's going to be a lot of, you would think, bears floating around this zone. And it'll be interesting to see what day traders do here. Looking at systems towards the short, systems towards the TPs. That's the type of thing people are doing. But it looks like they're defending 15,125 at this stage. A close below here though. Oh, get ready for a squeeze towards the shorts. Basically, everyone would be getting their stops knocked out, and at the same time would probably just be getting leveraged out. So that would be an aggressive short. You're going to see a lot of this. New lows being closed below on any of these indices will be a significantly big deal. Same thing with the Oz market. I would say for Australian viewers out there, it's pretty boring in the Australian market right now. Although it's been volatile, this level is really not about this chart. I think it's more about the American stock trading chart. So let's have a look at the Qs here. I've marked out on triple Q3 kind of 59, and I think, 362, my bad. So 362 is the mark level that I have here, and you can see that if that level is broken above, I would say that's a fairly positive thing for pullbacks. Again, this zone is starting to see some recovery, and I think it's got to do mostly with the Russell 2000. But let's have a look at IWM. I'll just type it in here on the chart, and what I'll do is I'll add a volume indicator onto it. So if we add a volume indicator on, we take a look at this, you'll see that we have a very aggressive amount of volume that's just come through in the last couple of trade days. Now, not historically massive, but just around here, especially this long leg doji, held quite a lot of volume. So it's recovering off that base. And if we go to the US 2000 futures, which we can load up now together, and then we go down to something like a 2 hour, you'll notice that this blue line that I've been talking about was closed above. Now, of course, there's always problems on the left-hand side, don't get me wrong. But with such a big, wide sell-off, with decent volume coming back in, with a relatively strong recovery, you're kind of thinking at this stage, we're going back to mean reversion. At least that is the way you're thinking about it from a stock market perspective. Now, if these lows are taken out, the lows that we just put in, of course, bears are in control. Time to get, out the bear hats and move towards those 4150, 4200 zones on the US 500. But a lot of it has to do with this trend line. So this trend line, everyone's watching it because it's a 50-day moving average. So you can see here, which is down in these lows. A 200 is what I meant before. So a 200-day moving average is sitting right down here. Then, of course, you've also got some other big moving averages and WAPs and stuff that you've got around this level, the trend line. And then, of course, underneath that, we're looking at some significant trade volume. The trade volume that went through this level over the last couple of years is massive, specifically around 4150. So if we do manage to take a new low, 4150 seems to be a bit of an equilibrium point for markets around the world, in specific the US 500. If we go to the futures, everyone's seeing this trend line, seeing this head and shoulders. Of course, a lot of people have this target, and the target sits at about just underneath 4150, about 4050, 4070. Now, I'm not sure if we can go that low, and that's why there's an argument to be said that this could be the low itself. Look at the 20 moving average. The 20 moving average here is quite a lot higher. So basically, we're at a point where if the market's going to go back to mean reversion, it's going to find strength, you would think, around here. It's going to move towards this level, and then it will make a decision. 4,400 and 43 kind of 80 also mark the previous support zone. So if we put a line through here, you can kind of see that you're starting to build a case for a pretty strong level as the market then recovers up. Let's go to the 2 hour chart, just to have a bit of an idea of what's happened. So the significance is here that we've taken out trend lines on the way down. We've found base structure in here with some strong wicks, and then we've found some buyers. So sells, especially even if we saw a sell like this, would be very, very aggressively bought, I would think, at this stage. Kind of like a defended level. Now, if that gets taken, if the new low gets taken, well, we move down to 4150 and what a lot of people think. But we do need to play with the data stats at this time of year. Historically, August and September are the weak months. They have been this year. That's what we expected on this channel. We also expected that sometime in October, which we're very close to, we would usually see the recovery start to place. Now, there are so many headwinds in this market. You could throw like every problem you could think of at these markets, but at least mean reversion seems to be the play. And I'll kind of explain it from a moving average standpoint. If you think about this market sell-off, and you put this red line here, which is the 20. 1, 2, 3, 4, 5, 6, 7, break. So What that means is that we've broken a very aggressive sell that's been very consistent. 7 times it's basically sold the 20 all the way down. Then something's changed. And I think we need to pay attention to this. Although I'm not necessarily super bullish or anything, I think it does need to be paid attention to whenever you're considering both sides. And whether you're a big bear or not, you still need to pay attention when these things happen. So of course, if markets then recover, you say, well, that makes sense for it to recover in this particular time frame. Remember, we talk about patience and reacting and not necessarily predicting. Unfortunately, sometimes it's hard for us to put our opinion at the door because, of course, we see on the news, we get fed information, and there's no doubt there's a lot of negativity out there. But there's also a possibility that markets have just seen a very critical level and they need to go back to mean reversion. So the 20 moving average seems like a possibility here on markets. We've seen some recovery. We've obviously seen some volume. Bitcoin's also done a lot better, bouncing off that level we were talking about the other day towards 27,000. And if we're kind of thinking these markets are bullish, then there's a good chance that Bitcoin will even try to go for a new high. So although I'm not trading Bitcoin, I do think that the chart doesn't look super negative at this stage, and we'd need to see more action if that was going to happen. More like a new low being formed, 26,000 underneath that. That's going to be something pretty significant towards the bear side. So what are some catalysts that could push us down here? Well, of course, core PCE price index is coming out at 8:30 New York time. That's going to be an important one for everybody to be watching. Then we see revised UOM consumer sentiment as well. But when we go through to the next week, so let's scroll down here for a second, you'll see that we start to get a little bit of interesting information coming out about some other central banks. So Monday, we've got the ISM manufacturing PMI. Then we go into the RBA cash rate statement. It'll be an interesting one to see if they do something surprising. New Zealand cash rate statement. And then we start to see non-farm employment change. But remember, the big nut data is going to be the jobs numbers, because everyone wants to know, well, what actually is happening in the US? Is it still hot? Will we have to have rates higher for longer? Of course, this is something that everyone's now saying is the problem with the Fed. So I think this will be the big one. Friday, October the 6th, mark it out. Make sure you're around. Make sure you're prepared risk-wise for it. But the jobs numbers haven't mattered as much as they will this time around, because everyone's super hyper aware of higher for longer rates. Thanks so much. If you enjoyed today's video, remember to subscribe, smash that notification bell, and we'll see you next time. I'm enjoying the time in the US. A few people have been asking. It's been great so far. So thank you very much for everyone's hospitality. And I look forward to continuing these videos throughout the journey over here. Thanks so much, everybody. Bye for now.